Yesterday's rate cut by the Reserve Bank was greeted with a cheer by homeowners, hoping to have a little more money in their pockets at the end of every month. But those smiles are starting to falter as none of the big four banks has so far followed the RBA and cut their mortgage rates. In fact, only two of the smaller banks have passed on the 25-point reduction to customers. They're the Bank of Queensland and the Members Equity Bank. With his views on it all, here's Alan Kohler, the host of Inside Business. So, Alan, how come two small banks can afford to cut their interest rates, but the big four seemingly can't?
Because the small banks get all of their funding from retail deposits, and all of the banks, big and small, will be, as we speak, cutting their deposit rates right now by 0.25% because they can, and they obviously want to pay the depositors less if they can. The problem is that the big banks get a lot of their funding from overseas, from wholesale financial markets, and that's on a kind of a rolling 3-year basis. So what they're having to do is replace old funding with new funding, and the rates are higher now than they were when they took those loans out. So their funding cost for wholesale markets, is going up, even as their deposit rates are falling. And so it balances out. I mean, what I don't understand about the banks is why on earth they announce their changes to mortgage rates at the same time as the Reserve Bank, when the Reserve Bank isn't the only influence on it. If they've got increases or reductions in wholesale rates, they ought to announce it at the time, not just when the Reserve Bank moves. So anyway, I've told them that, they just don't listen.
They don't listen. Now, what about this argument that there's some kudos and really big brownie points to be earned by cutting their variable mortgage rates and being a step ahead of their competitors in a highly competitive market?
Yeah, well, obviously they're conscious of that, but they're even more conscious of their profits. So it's a question of balancing the two, I guess.
All right, let's move on to growth figures now, giving us further clues of when the next rates move might be. We're talking GDP. Here are the numbers. The economy grew 1% over the September quarter, significantly up on the forecast 0.8%, and the annual figure of 2.5% is well above the forecast of 1.9%. So, Alan Kohler, these are pretty strong numbers. Do they make another rate cut in February less likely?
Probably. The Reserve Bank didn't cut yesterday and in November because of a weak domestic economy. It's all about Europe, and they're taking out insurance against big problems in the global economy, and it's looking more and more like there are going to be big problems, even if the European leaders come to some sort of deal this week at their summit. Europe is heading into a recession. The American economy is pretty slow. China's slowing down. So the global picture is quite challenged at the moment. The Australian economy, as you point out, is going okay. There's no problems in the Australian economy, although there are some weak spots because of the currency being so high. Manufacturers and tourist operators are doing it tough. But, you know, the Reserve Bank is still going to have its eye on the global picture and Europe in particular. So it'll really depend on what happens there, what they do in February. But I do think there's probably still another rate cut to come because of the slowing global economy.
All right, good to talk to you, Alan. Thank you.
Thank you.